Hello everyone, Kolonji Murray with Tax Assurances. Just wanted to do a really helpful video around taking distributions out of retirement accounts. Unfortunately, one of the challenges that I come across every tax season is someone or even a couple takes money out of a retirement account and they don't pay enough in taxes. So let's say, for instance, you've got a married couple and they're making, the wife makes a certain amount, the husband makes a certain amount. And then on top of that, they've got children, they've got a house, they've got an investment account, but for life reasons, they take money out of a retirement account, whether it's for renovations or start a business or emergency expense to help another family member out, or any number of other reasons that life says, look, we need to take this money out. So they take the money out. What they don't keep in mind, and unfortunately what happens quite frequently, is the company or the employer that they work with defaults to, let's say, just taking out 10%, both at the federal level and in certain states, the state level. And I come across this too frequently where it's not enough. And what should be happening is the couple should really sit down. Obviously, they're going to sit down and discuss what the need is for that money. But on top of that, what they want to do is they really want to figure out, like, what's their tax rate? So they need to figure out, okay, how much am I going to make as the husband? How much am I going to make as the wife? And combine that, and along with those two combined incomes, or three or whatever incomes, and let's say they've got an investment account, taking that, but then on top of that, adding the IRA or the retirement account distribution, and then getting a total amount for the entire year in terms of what is taken out. That's the critically important information that they need to really take out of that process. So again, it's making sure that they know what they need the money for, but making sure they understand at the end of the year, ultimately, what is their family tax rate. And that family tax rate is what they want to have taken out of that retirement money. The same way they want to have it for the husband's income and the same way they want to have it for the wife's income, they want to have that family tax rate taken out for the retirement income. Obviously, if you've got more questions around that, by all means, I would love to sit down and go over that with you. But it's something that, as a takeaway, you really want to make sure you get the family tax rate and understand what that rate is before even sometimes after. Like, let's say, for instance, you do understand, like, you took the money out and you just did it quickly. But before you may sit down with someone like me, you have a clear understanding of what that number, what that rate is that you want to have taken out. Now, worst case scenario, let's say you take the money out and you aren't sure what the rate is, you sit down with someone like me. It can be a situation where if you do, for instance, owe money, you can work out not a retirement plan. You can work out a payment plan to kind of resolve that. But it's something that ultimately, whether you pay as you take it out or you make a payment plan, you need to address. And again, the way that you can address that from the initial stage is making sure that you understand what that family tax rate is from the very beginning of the process. Again, if you've got more questions about your circumstances, I would love to help. But until then, have a good one.